Welcome back. Let's get to the call of the day on the street. MoffettNathanson's Craig Moffett downgrading Apple not even just to neutral, to sell from hold, giving it a 188 price target. It's at 243, so that's about 20% downside to where Apple's trading now. He writes Apple is still a great company, but valuations are stretched, and its hand in China is weakening. And the company's AI has not driven the upgrade super cycle that it was supposed to. We have Craig Moffett with us on the phone. Craig, very few people get to be phoners, but whatever you're doing, thank you for making the time to join us today. Welcome.
Thanks, Kelly. I'm glad to be here.
So this is when's the last time you had a sell rating on Apple?
This is the first time I've had a sell rating on Apple. And look, I think you said in your intro, and I want to underscore it, this is not a call that says Apple is a bad company. It's not a call that says Apple is broken. It's a call that simply says that the valuation has run too far and that there are legitimate risks that simply aren't being discounted in the stock today, and that it makes sense for people to be more cautious.
Is it trading at an all-time high valuation?
Yes, you're looking at Apple trading right now at 33 times earnings, and where what I think particularly jumps out is, remember, Apple is no longer a brisk growth company. So when you think about its peer group among the Mag 7, say among Apple and say among Amazon and Meta, for example, or Alphabet. The PEG ratio, that is the ratio of the multiple to the growth rate, the PEG ratio is above 3. All the others are around 2. So if you look out even a year or 2 years, the valuation that is implied here starts to be ridiculously stretched relative to the rest of its peer group. And the rest of its peer group, let's be honest, is not cheap. This is not a moment when anybody would say that the Mag 7 are trading at bargain multiples.
Right. And we were all a little surprised when it started to just take off last year. I mean, there were 5 straight weeks where it rose 2% or more on no real news or developments that I could discern.
Yeah, that's right. Let's actually retrace a little bit of what happened in 2024, because we started last year with this narrative that Apple was behind in AI, and it lagged pretty badly during the early part of the big AI rally last year. As we got closer to the Worldwide Developer Conference in June, the market started to anticipate what the strategy was going to be, and by and large got it right and loved the strategy, and rightly so. It's a capital-light strategy. They have all kinds of advantages in agentic AI, that is AI that can schedule for you using your calendar and your contacts and email and what have you. All of those things are true, and the market figured out that they were coming, and the market rightly started to price them in. So that when we initiated coverage last year, while we really liked the strategy and thought that Apple was really well positioned, it looked to us to be fairly fully valued. The market then started to come back to a view that, well, wait a second, Apple is actually a couple of years behind in AI. And so the market was a little more sober. To be honest, during the last part of the year, it mostly traded in line with the market for the last part of the year. Although over the last part of November, December, it really started to rally quite strongly. And as you said, what was supposedly no news, but in fact, there was actually quite a bit of genuine bad news that should have actually made the investors more cautious.